This is being recorded for the Absolute Alerts Discord. The link is in the bio. So feel free to join our Discord. Feel free to subscribe and like the video. We are constantly giving call outs and we're always looking for new people to make money with us. I'm going to start off by explaining what options are on the basic level. I'm not going to go into too much detail. I'm going to give you guys the beginner's rundown pretty much, because I don't want to get into all the Greeks today and so on and so forth. I think that just explaining the basics of options is going to be enough for you to let them marinate over the weekend. And, if you want to do some extra research, you're more than welcome to. I will start by saying this, though. People with accounts that have less capital are more likely to gain more from options than from trading stocks. And I'll explain why. When you buy options, it's not like buying stocks where you're buying, one share or 10 shares. Options are, you buy them in contracts. For every one contract, it represents 100 shares. So say you buy 10 contracts of NVDA, then you would be essentially buying 1,000 shares of NVDA. Now, in the option example that I sent out today, that cost us about $7,300 to buy 1,000 shares of NVDA on options. However, if we were to buy the stock, $195 per share times 1,000, you would need $195,000 in order to buy that many. With options, for my option call out today, it only costs 7,700. Now, another good part about options, aside from being able to play higher positions with less capital, is the reward could be also a lot higher. For example, if you would have did my options play today on NVDA, you would have, if you sold at the right time, if you sold your options contract today at the right time, you would have ended up making about $1,300. The reason for that is because with options, the way it works is you pay a premium to buy the option. It's like, I'll use, I guess, the classic house metaphor. You come up to a person who's selling a home and you tell them, okay, I want to buy this home for $200,000 within the next 5 years. Now, the home's price could go up within 5 years, but he is obligated to sell you that house at the agreed upon price, no matter what. So, you come to him 4 years later. Now, the home that you agreed to buy for $200,000 now costs $400,000. So you buy that home, you exercise your option, and you're able to buy that home for $200,000 and then resell it for $400,000, giving you a $200,000 profit. But the key is you do not have to exercise your options. Every time you buy an option, instead of exercising it and buying those shares, you could sell the option back. And I wouldn't say back, but you could sell the option and make your profit. So if you bought an option, say, for example, the premium on it costs about $2,000, and the option was that AMC is gonna hit $50 but within the next 2 weeks. If it hits $50 and you have one contract, which is 100 shares, for every dollar it goes up, you get $100. Also, the premium for that option gets more expensive. So when you sell that option to somebody else, instead of exercising it and actually getting the shares, you're making a profit just by selling that option to somebody else or selling it back. Now, the tricky thing with options is they have decay ratios. Like I said, I'm not going to go into Greeks today, but I will give you a quick rundown of decays. And that is, if you buy options that say are expiring in 2 weeks, because just like I said with the house metaphor, you have a agreed, amount of time to either exercise the option or sell the option. And the closer it gets to that expiration date where your option is done, the less profit you make. So if I buy an option where, I'm going to be making, let's say I say stock A's price is going to go up by $5, and I buy it and it expires in 2 weeks, and stock A's price does go up by $5 the next day, I'm going to make a lot more money than if stock A's price went up by $5 2 days before the option expires. I will obviously, I'm going to do another Zoom session later where I go into detail on Greeks and how to, measure decays, and, you got your deltas and so on and so forth. But for now, all you need to know about options is if you have a small account with a little bit of capital, then I would say the least risky scenario for you would be options. Why? Because the most that you could lose is the premium that you pay. That's when you're buying call options or put options. And the difference between a call and a put option is a call option is you're betting that the price of the stock is going to go up. A put option is you're betting that the price of a stock is going to go down. Now, there's a very, very important thing that I want you guys to understand. And that is the difference between buying call and put options and writing call and put options. When you buy an option, the most you could lose, like I said, is the premium. You cannot lose 100% of your capital. You could lose 100% of your premium. There's a very big difference. You pay a premium to buy an option. So if your capital, say, is $50,000, but you only paid $1,000 for that option, you could lose only $1,000. That's it. That's your maximum loss. The rest of your $50,000, it stays there. But your potential for gain is unlimited. Why? Because, say I bought options on NURO when it was $5 a share, and I said it's going to be $10 a share, and then it went to $40 a share, and say I had 10 contracts. Now I'm making huge money, and it went up fast within a day or two. So, the upside is huge. The downside is limited. Now, this is when you buy options, whether it's calls or puts. If you sell options, it's the exact opposite. You have unlimited loss potential. You could lose every penny in your account, but you could only make a certain amount. Why? Because let's say I buy an option and you buy it for me, and I say that, ABC is going to go up by $3 and it's currently 30. So the strike price, is basically what you're expecting the price to be. When it comes to options, like I said, there's the expiration date, there's the strike price, and there's the premium right? I forgot what the exact name for it, but it's basically what always happens is, say the company stock is $10 and the strike price is $15. That option is going to cost you $5 because it's an actual federal law that when you combine those numbers, it has to come out to the exact price of the stock. I'll explain that more in detail later, but that's the way it works. So if I was to write an option saying that stock ABC, which currently is $10, is going to go to 13, and somebody bought a put on that, and I was wrong, and instead of going to $13, it fell to 0, then I'm going to lose all the money that it takes to pay out for that option. So when it comes to buying options and writing options, your best bet is always to always to buy call and put options rather than write them. There is one exception. That one exception is called covered calls. A covered call is, say you already own 1,000 shares of ABC. Now, you could actually write an option on those shares that you already own. And this way, the only risk that you're taking is the amount that you invested into the shares that you purchased already. That's why it's called a covered call. It's covered by the shares that you already have. So you're going to give them away. They're going to get it at the price that they, if they actually got the option price right, if they hit their strike price, they're going to get it for that price, and you lose your shares. You might, come out a little, we'll say, more on the negative side, but you're not going to lose your entire account. You're not running that risk anymore. A covered call is a covered call. You're covering your own ass by basically owning the securities that you're writing the option for. So that's a basic rundown on selling options. But I'm going to repeat again, for now, none of you guys should be writing contracts. If you're writing options contracts, I'm going to say right now, I'm not going to help you because I don't want to even get involved with that risk. Even I don't write contracts myself. Why? Because of the inherent risk that you're taking. When it comes to buying call options, now that is a good idea. If you see that, you think a stock is going to go up soon, you could always buy a call option. And you have options that you could buy that expire in 1 week, 1 month. You could buy options that expire years from now. You could buy Amazon options that will expire years from now. And usually the premium of the option is the same exact price, like I said, as the actual stock per contract. So, if you buy a option, let's see over here, for BDA, NVDA, over here you have your option chain. You choose your expiration date. Today, I think the call I did was for August 21st. Now, over here and over here is basically your calls and your puts. So if you think that the price is going to hit $197, let me get rid of that bottom thing. There you go. So if you're going to bet that by August 27th, 2021, the price of NVDA is going to be $197.50, which is your strike price, then you're basically paying this amount. There's a difference in to buy that, and that's how they come up with your premium. Now, if you look, I'm sure some of you guys already noticed this. Why is this purple? Why is this purple? Why is this black? Why is this black? And why is it flipped around? Like I said, these are puts, these are calls. Now, the purple ones are calls that are in the money. In the money means that right now, the current stock price is already the price that it has to be. So, NVIDIA right now is $195.58, and you're betting that it's going to hit $192.50. So right now, it's already in the money. This over here is out of the money. That's what they call it, out of the money. So if you're going to bet that it's going to hit 197, now this option is going to cost you much less than this. As you can see over here, the prices go down as you go further away. $190 is going to cost you $14.15 per share instead of paying your usual 195.58. But for 197 strike price, it's only costing you 10.15. So say I'm betting on this, I'll buy that, like that. Over here, you put in how many contracts you want. Remember, each contract is 100 shares. So with 10 contracts, that's 1,000 shares. Altogether, it will cost you $10,000, $10,150 as a premium, and that's the same thing as your max loss. So this is the price right here, and it's also the same exact thing that you could lose. Now, the person that you are buying this option from is making this premium, which is the part that makes selling options so attractive. Because when you sell options, you get to keep premiums. You could keep selling options and keep racking up money in premiums and just make money off of that. But like I said, the potential risk of loss is a lot. Like over here, it says the max profit is infinite. If you were to sell this option, it will be switched around. Your profit will be this, but your max loss would be infinite. You could lose your entire account on one bad play. So instead of spending the $195,000, you spend $10,000, but you would make a great amount of money. If it actually, if it hit the price. And there's a lot of things that go into it. Like I said, this is just a basic rundown. The break-even stock price would be 207, but that doesn't mean that you're not making money. That's just to pay off your premium, but you're still making the money on the actual option. And you could sell an option at any time. So even though this option is set to expire on August 21st, you could sell it tomorrow. You could sell it, a week from now. As long as you make sure you sell it before the expiration date. Always sell your options before the expiration date. I cannot stress that enough, because if you do not, they will execute. And people have been burned by that a lot. So unless you actually plan on buying those shares for that price that you originally agreed upon, like in my house metaphor, make sure to sell that option so it does not execute. And options are available for pretty much any stock that is not a penny stock. If it's a penny stock, then you do not get the choice for options. So if you went to, I don't even know if XELA has options. I'm not sure. Yeah, they do. But most penny stocks, they don't have options. Usually, for me, I define a penny stock as anything that costs below $5. So that's the basics of playing options. And I would recommend that you guys, of course, as always, practice with paper trading first. Buy some options on a paper trading account. So, choose a strike price, do a call option on the stock that you think is going to go up, and see if you win. If you could make money in paper trading, then you will be able to make money or have a better chance of making money with real cash. But definitely, if you are new to options and you are just getting started, definitely first practice with paper trading. So say it hits your strike price, what's my profit? After the strike price, for every single dollar that it goes up, I make 100. And that is per contract. Because each contract is 100 shares. But you're gonna start making profit before you even hit your strike price. That's the catchy part with options. Even though you're setting a strike price, where you're saying it's gonna hit this amount of money by this day, as long as that stock price does not go down, you begin making the profit. So if you set a strike price of $200 when the stock is currently 190 and it goes up to 191, you're already making a profit. It goes up to 192, you're making more of a profit. Once it passes your strike price, then you're going for, true, like real high gains. And the faster it gets there, the better it is, because like I mentioned earlier, there is a decay. But if the price goes down, it's the same thing as if you were to buy a stock outright instead of options. If the price goes down, you start losing money instead of making money. So that's why they have the call options, which means you're betting that the price is going to go up. And they have the put options where you're betting that the price is going to go down. Got a question. So if it goes down, you can't sell the call option, you lose the premium? No, that's not how it works. As the price is going down with a call option, you're losing parts of your premium. You don't lose the whole premium right away. That's your maximum loss. So if you're saying that the price is going to be 15 and it's currently 11, it goes to $10, you are losing just a percentage of your premium, the same way you would as with stocks. So basically, if it goes down by $1, you're going to lose about $1 per share on one contract. One contract is 100 shares. So you're losing about $100. But you don't lose your entire premium if the price falls just by a little bit. The amount you lose all depends on how much it falls by. But the maximum you could lose is your premium. When buying a call option, should I make sure that there isn't a few days left on it? I mean, that's up to you. I know people that buy options that expire in 3 days. And I know people that buy options that expire in 3 years. That's completely your decision. But on that note, I will refer back to risk management. But at the same time, I'll also refer to price. The longer out the option is, the expiration, the more expensive that option is going to be, the premium price. Why? Because you're giving them more time. And with more time, you're giving them more of a chance to hit that strike price. Now, if you buy an option that expires in 7 days, it's going to be a lot cheaper than an option that expires in 1 year. Why? Because there's much less of a chance that you're going to hit your strike price in 7 days than in a year. I mean, we're looking at, about, let's see, 358-day difference. So, the further out that your option's expiration date is, the more expensive that option is going to be. Options usually, they expire on Fridays, but they don't expire at 4 p.m. Always keep that in mind. They expire at 3. You have to either sell or exercise your option by no later than 3 p.m. Can you talk about the process of selling the option and or exercising the option? Yeah, if you sell the option, basically what you're saying is, okay, I made money, I've covered my premium, and I'm now profiting, but I do not want to buy these shares. So I'm selling the option back, just give me my profit. That's selling an option. If you exercise an option, then you're actually going to purchase the shares that you originally, agreed upon when opening the option at that original price. So, if you opened the option and the stock price at that time was $10, and now the stock price is $50, you could exercise that option. And the person who wrote that option has no choice but to give you his $50 shares for $10 each. And that's why the people who write the options have unlimited risk. Other question, let's see, when you sell your option, do you get your premium back? No. Once you pay that premium, the premium is gone. You will never get your premium back. I guess you could look at it, the premium is basically what you pay to have the option to buy the option. But, as long as everything goes right, when you sell your option, you kind of do get your premium back unless the price went down. So for NVDA, if you had one contract, are you hoping your profit will cover the premium cost and net you profit? For instance, your 10 contract example that costs 10K. If the price went up by $1 and you sold that option before it hit your strike price, you'd still be at a loss, right? No. If you bought my NVDA contract or option today, when NVIDIA was $192, you could have sold it but say you bought it at today when NVIDIA was $192, $193, and you put a strike price of $200, you could have sold that option when NVIDIA was 196, and you would have covered both your premium and you would have made a profit of about $1,000. Because with options and premiums, just like there is a decay value, there's the price decays, but the sooner you sell it, the more money you make. So as time passes, the price does decay. But at the same time, if you make that money right away, the second you get the options, then you could actually make more money than you would with stocks. If you use Webull, you got options in here as well. You could even, right here is showing you both calls and puts. You could just show calls, you could just show puts. Like I said, same thing as on the other side. As you can see here, this is, in the money. This is in the money for the puts. Out of the money, calls, puts. But, these are 7-day options right here. These are weeklies. But you would never find an option that expires on a weekend. Thanks everybody for watching. More videos to come. We usually do them once a week, and I will see you later.